Hey guys, big question this week. When can rental income be used and what proof does the lender need? Stay with us and we'll talk about it right after this. Hey guys, great question this week. This is Aaron with Marsh Lending down on 30A in Florida. So the question is, when can rental income be used and what proof does the lender need? Okay, so a lot of different lenders look at different things in terms of rental income, right? So it really kind of depends on what lender the loan officer is working with, what kind of type of underwriting that they need to qualify the loan. And really it kind of breaks down into three different buckets or a blend of the three. So let's kind of walk into it. So first step is if it's an existing property, so it's a turnkey property, it's someone owns it right now, they're selling it to you, it's a rental property now, you'll continue it as a rental property, that's called actuals. And so what they'll do is they'll take a look at it, and from an actual standpoint, they'll look at what is the preceding or the prior 12 to 24 months of rental income, and then they'll use that as projections going forward, and then they'll put that in your qualifying of the loan. All right, so they'll use that as part of your income calculation. The second one is the appraisal. So when you get an appraisal done, there's a study that establishes the market value of your house, right? Also, there's an additional study that can be done that determines the market value of the rents that you can expect based on the comparable properties that are renting for the same, square footage, bedrooms, all of the, like for like within the neighborhood. So they can use that number, which is off the appraisal. And the underwriters really typically, they check the box here, they check the box there. That's really the top two. There's a third version where it comes from property management groups. So property management groups, especially large ones, have big databases of the houses that they already manage. So 50, 100, 150, 300 houses, right? So they use their database and all of their data in terms of trying to put together a projection for you. So the underwriter will take a look at it. If it's an existing house and it has a lot of rental history, they'll probably use actuals. A lot of them, to balance or to bolster the actuals, they'll say, okay, we'll take the actuals plus what did it say on the appraisal? How close are these two numbers, right? And then let's say it's a new construction or it's a new house or it doesn't have a full year's worth of rental history. Sometimes they'll say, okay, well, there's not enough actuals, but there's enough off of the appraisal, and we can see what the property management group can say, conservatively, this is what this house is going to do in the near future, right? For the next year, the next 2 years. And really, so it could be one of each of these, or it can be an amalgamation of all of them, right? So it can be a sum of all of them together. And that's really what it takes to kind of decipher what rental income can be used and how do we proof that out. So to recap, really you're looking at, can I use rental income? Yes. How do we proof it out? So there's really three types. So there's really the actuals piece. If actuals exist, if actuals don't exist or not good ones, then they'll use it off of the appraisal. The appraiser assigns a rental value to it on the appraisal itself. And then there's also the property management group and their projections, right? So they can use one of each or they can use all of them together and come up with a blended rate. But that's really how you answer the question of what are underwriters looking for? These are the things they're looking for. I know that was a lot. If you have a question, you can reach us in the comments. And if you want more information or you have further questions, our contact information is in the description. Until we talk to you next time, remember your rental income types, and we'll talk to you soon.